Hello, everyone. Welcome. This webinar is brought to you by Saturn Advice. The topic today is Market Outlook 2024. My name is Joyce, a financial advisor at Saturn. Also with me today is Shahrukh Abdali. Hello, Shahrukh.
Hello, Joyce. Hello, everyone.
As a way of introduction, so Shahrukh is also a financial advisor, a CFA charter holder. He also sits on our investment committee. Most of you follow his monthly commentary video would know him really, really well. So today we are here to talk about market and how investors should think about investing in 2024. You know, Shahrukh, in the start of the year, when I go out to see my clients, a common question I ask them is, what are you most excited about this year? And the answers span from going on an overseas holiday, starting a new project, or welcoming a new member to the family, a new grandchildren, for example. And no one ever say that they are excited about investment markets. Unlike us, particularly you, I know that you are very passionate about this stuff and you are on it 24/7, aren't you?
Pretty much. I wouldn't say 24/7. You gotta sleep, but yeah, I do keep a tap on the markets as much as I can.
Fantastic. And I think this just reminded me that we are fiduciaries for clients' money. And, we take care, because we are passionate about it, and we take care of an aspect of people's lives that most of people probably find it a little bit daunting, boring, and too complex, so that we free up time for people to actually do the things that they are more passionate about. On that note, I'm just going to hand it over to you to cover the disclaimers.
Oh, thank you. So look, we are not giving any personalized advice. This is more for the general information. If you want to seek specific advice with respect to your circumstances, please get in touch. Do not act on this without seeking financial advice. This is just to inform you our views and opinions and information from the market, third-party sources. We have taken full, due diligence in terms of collecting information, but can't really guarantee the accuracy because we are reliant on third-party sources. And nothing from this presentation can be used to put a liability on me or anyone from Saturn, their directors, contractors, associates, or staff. So yeah, that is the disclaimer. Do get in touch if you do want personalized financial advice, but this is for information.
Right, thank you. That should get the lawyers out of the way. In just putting a bit of context around the Saturn Advice, Saturn group of company, we've got 3 parts to our business. Both Shahrukh and myself work in the Saturn Advice arm, and the business specializes in providing independent financial advice and investment planning. We also have another business called Saturn Invest, which accepts pension transfer from UK. Last but not the least, we've got the National Capital business, which provides digital advice for KiwiSaver members. I'll hand it over to you, Shahrukh, to talk about markets.
Thank you, Joyce. Just one thing, going back to National Capital, it's worth mentioning that their service is free, so there is no cost of seeking advice on your KiwiSaver. So it's practically a no-brainer. You're not getting any advice on your KiwiSaver. Here's a company that is willing to give you advice, National Capital. So yeah, we can get in touch and we can hook you up with them, or you can Google them and check them out. So what I'll be talking about is different asset classes, different sectors, and giving you some insights into what I think is the outlook for each. Starting out with international shares, international equities. You can see the graph on the top left. It shows the performance of the major indices across the world. The first one is S&P 500. Then you've got Nikkei, which is Japan. then you've got MSCI Europe, FTSE is UK, and then MSCI EM is the emerging market. What is pretty evident is we've just had a really strong year. So that's the second bar, the not the very dark blue, the leftmost, but the next one, which is the grayish blue bar, which is the tallest of the lot. By the way, I didn't arrange them such that, the bars go decline towards the right-hand side. It just happens to be that the US had the best performance for the year, followed by Japan, and then Europe and UK, and the emerging markets have been lagging. But that's the story. So we've had a really, really strong rebound to a very, very negative 2022. You can still see the impact of that 2022, particularly for emerging markets. You can see the gray still pointing down, so still a negative return for the 3-year period for the emerging market index. But the strong performance in 2023 has pulled up the 3-year returns for most major indices. What has been happening is the growth has persisted while inflation has been declining. Growth persisting has been driven by consumer spending. Consumer spending is, well, it took off post-COVID as the world came out of the pandemic. People had a lot of savings from the pandemic lockdown periods. But there was also a lot of wage inflation because of labor shortages. A fair part of the labor market decided to just, retire. Those who were near retirement decided that they can't be bothered coming back. And a lot of people who had accumulated a fair bit of savings delayed coming back to the labor market. So there was some pressure in the labor market, and that resulted in wage inflation. And as I have explained previously, wage inflation is the stickiest. But what it is also doing now is that as savings have been used up, the wage inflation means that the consumer still has money to spend. And that spending is sustaining economic growth. Meanwhile, the monetary policy impact, as we've discussed this many times before, and everyone is aware, interest rates are much higher than where they were about 2 years ago or 18 months ago. And those high interest rates are restrictive to economic growth. But economic growth is still holding up courtesy consumer spending. Now, it's a delicate balance. If inflation continues to decline without the economic growth going into the negative, we will have what is called a soft landing, which is we do not have a recession. But it is also very much possible that before inflation is structurally down to target, or the central banks believe that it is not going to spike again, before that happens, the economy goes into a recession and economic growth is negative. So, yeah, that is all ahead. But what we do feel is that interest rates have peaked. It is very unlikely that we will see interest rates going higher again from where they are. Some central banks, including the US Federal Reserve, have already started to indicate that they expect interest rate cuts in the near term. They have pointed out that they will be cutting. They expect 3 cuts this year. The market is probably pricing in 4, maybe 5. But what that means is the interest rates are going to come down. The trajectory is probably a bit uncertain, and that is what is going to drive the share market returns over the from week to week basis. Micro factors are taking center stage now. Earnings are the key. I have I in my 6 month ago when we did this last time, I said the earnings announcements will determine what the price movement is, and there were downgrades in 2022, which had resulted in prices falling in expectation that we will have a downturn and earnings will be impacted significantly. Because of the sustained economic growth, earnings have actually held up reasonably well, and hence we've had the rebound. I will talk a bit further about where exactly that rebound has been centered, but largely earnings have stayed resilient across the board. There are obviously some businesses that are struggling for, either their balance sheet is not strong enough, they've got too much debt to handle, and that obviously is now a lot more costly as they roll that over, given the higher interest rates. So there will be business failures, and that's a normal part of the economic cycle. But by and large, it's not looking as bad as it was maybe a year ago. Financial markets are obviously forward-looking, so they have priced in the improving situation, the outlook already. I would say probably just a bit ahead of themselves. This year, S&P 500, for example, is already up over 4%. Last year was something like 24%. I don't believe that we will see such a strong year, but I do think that this year is also going to end up as a positive year. So there will be some turbulence, some volatility, but by and large, I think it will be a positive year. Now, reason being why I believe that it's going to be a positive year is because last year's rally centered around a handful of companies, and those were technology-based companies driven by the artificial intelligence theme. They were touted as the Magnificent Seven, including the likes of NVIDIA, Tesla, Microsoft, and some others. The rest of the market, there was a graph that I shared in one of my monthly video updates, showed the S&P 500 equal weighted index return. As of October, that was still negative, or practically zero, while the S&P 500 return was something like 12% positive. We had a strong quarter there on, and the equal weighted index also started to go up, which was indicative that now rest of the market is beginning to participate in this rally, and hence the reason why I believe that this rally might have a bit more runway, and we might end up with a positive year in 2024 as well. Going forward, high quality companies offer good value in my view. Outside of the technology sector, perhaps, I think the technology sector has been priced very well for the growth outlook. All we need is for them to continue to deliver on the expectations. If there is a miss on the expectations, then obviously the share price will get hammered. But there is quite a bit of value to be captured in the non-technology sector. So think energy, think financials and others. Among emerging markets, Indian economy looks promising. China has got its issues right now. Obviously not written off, but they've got their property sector to deal with, debt problems there, and their economic growth is not really kicking off since they took off their COVID zero policy, which was over a year ago now. But the consumer spending hasn't really rebounded the way they had expected. So they've got some issues to deal with right now, but by and large, emerging markets offer good prospect. It's just emerging markets have always been underpriced, or you can say like a bit undervalued for the better part of the last 2 decades. Whether that underpricing continues or they come up, they outperform and they recover ground and outperform the developed markets, it remains to be seen. But there are some bright spots among emerging markets. I can't move on without talking about geopolitical risks, obviously. A lot of questions from clients that I've been receiving about geopolitical conflicts. You've obviously got two wars happening. One of them can't really be called a war, but it's a conflict. The markets price in those risks as they happen. So when these conflicts broke out, there was an impact on the markets. However, as things stand, they have been priced in. It's only if there is a change in these conflicts, it's going to have an impact on the financial markets. Now, that change could be for the better. You have a resolution of the conflict and there is no conflict anymore. And then suddenly, you've got a boost for the markets, or there is a further escalation in either of the conflicts, or there's a new conflict that surfaces, and suddenly you've got another impact to the downside for the financial markets. What I would say is there has been quite a bit of concern about the impact of the conflict on the oil market per se, and the disruption there. Now, I don't think that is the base case. Obviously, that is the worst case, but I don't think that's the base case that this will cause a disruption in the oil market. But even if it does, that's my personal view, that all these other parties were sort of sitting on the sidelines, lamenting that there's a conflict going on, it shouldn't be going on, and there's a loss of human life, and it should get resolved. They'll then suddenly get a lot more active because the oil market, a disruption in the oil market is going to affect everyone. So those who are sort of verbally or not as proactively taking part in resolving this conflict will suddenly jump on their feet, and the resolution will come quick. So even if the conflicts become wider and start having a material impact on the oil prices, the oil market, or other trade supplies, it will be a fleeting impact. It's not going to be a sustained long-term impact, because there will be suddenly a lot of other more powerful parties jumping in to get this sorted. So that's my view on where we stand on the global markets.
Great, that's reassuring. Thank you, Shahrukh. I'm hearing about your view on geopolitical risk, because we are certainly fielding a lot of questions from clients at the moment. So if I am to sum it up, sounds like we are expecting interest rate cuts this year. It's a matter of when and how much. There will be more. There are still a bit of uncertainty and volatilities, but overall, your view on international share market this year is bullish.
Yes, by and large, yes, it is bullish. It's positive, obviously under the overhang of some caution, but yes, I'm overall positive for this year.
Great. Well, let's move on to Australasian shares. It's a great segue for me to ask the question in terms of Australia and New Zealand shares. Are you bullish or bearish?
Okay, so this is a tougher one. I'm probably, I'd say I'm cautious, I'm neutral. There are some positives in terms of consumer spending surprisingly being resilient in New Zealand as well as in Australia. However, as I have pointed out previously, New Zealand economy is not in such a good space as, for example, the US economy. And therefore, the path forward for the New Zealand economy is a bit more uncertain. However, we've had really, really strong net immigration last year. The borders were open late 2022, and then that resulted in a record level of net immigration last year. That has provided economic support with support for spending and economic activity. However, from what I have heard recently, the net immigration numbers are beginning to normalize a bit. So that impact is also going to fade off. And in the meantime, the central bank in RBNZ has maintained its OCR at a very restrictive level. And there is the lagged impact of that restrictive monetary policy stance, and we will see that unless that stance is eased. I can't see the OCR getting eased in a hurry for a couple of reasons. One, that inflation is proving to be stickier in New Zealand than the rest of the world. The latest figure that came out still had it inflation at more than twice what the target is for New Zealand. So yeah, it is still a fair way off, and RBNZ, the mandate for RBNZ has been reduced to the sole mandate of managing inflation from looking at unemployment as well as price stability. So with that, I don't think RBNZ will be in a hurry to ease back from its monetary policy. It may be a few months, maybe a later part this year, where we will see the OCR start to come down, unless we see economic activity fall off, which again is a bit uncertain because consumer here is still spending. You go to any cafe and it still seems to be pretty buzzing. You go to a mall and you're still struggling to find a parking spot. So clearly people are still spending, which is sustaining economic growth, but that also in theory goes hand in hand with inflation. So that is also sort of keeping inflation from falling off quickly. Again, it's like, what the outlook is going to be. It's a bit uncertain. It's positive that economic growth is sustaining itself, but the New Zealand economy could fall off into a recession if the interest rates remain high for much longer. By and large, the macro factors, we do feel that they've peaked. There is some views out there that the OCR might increase and interest rates might increase. I don't think I don't fall in that camp. I feel that the next move interest rates is going to be lower because inflation is declining. It's slowly, but it's declining. And I think the earnings will again take the center stage, much like global markets. If there is an earnings downgrade, well, we saw one for Fletcher Building this week, and obviously the share price got hammered. So there will be those, and there will be some failures as well. It's a normal part of the economic cycle, but if there are earnings upgrades, there will be some upside to the share price. Among sectors, I think the resources sector in Australia may benefit from higher commodity prices, and healthcare offers good value over the medium term, while consumer staples and utilities across the two countries are defensive in nature. So, yeah, that's Australasian equities.
Great. Well, it sounds like earning resilience is still the key, and it's about the selection of the stock as the performance might diverge within the index, reflecting the underlying earning results.
Yeah.
And
one thing to just add there is, like, you can see I didn't talk about the graph in the top left. You can see the New Zealand economy, which is the first three bars, has clearly underperformed the Australian market over the quarter, the 1 year, as well as the 3 year period. So that also says something. If you've got a home bias, and Kiwis are, we do have a home bias. We love our local names. We are more familiar with them, and oftentimes we would like to invest in the companies that we've heard of and we know. But that is where the diversification impact really becomes pronounced if you are really focusing on just such a small share market. It represents less than 0.5% of the global market capitalization. So yeah, it was a really star performer for a good 10 years until 2021, and from there on it just hasn't really kicked off. But that's the key. It's such a small share market driven by a handful of stocks. So yeah,
and that's one of the reasons we underweight Australasian shares.
Good point. Good mention.
Thank you. And I also can't help myself. Just want to say that anybody with a mortgage would really welcome some rate cuts this year. All right. So international infrastructure. Same question to you, Shahrukh. So in 2024, are you bearish or bullish on this asset class? And what would need to happen to change your view?
Okay. So it's an income-producing asset class, and income-producing assets generally appreciate in terms of their value as interest rates come down. So the outlook for interest rates is to come down. So I would expect appreciation for the underlying assets within the sector. So I'm bullish on the sector as well. Yeah, so that part is covered. So within infrastructure, I mean, you can see the graph there. The quarter was reasonably, strong. Actually, pretty strong for a quarter. It's about 5% for a quarter. The 1-year return also is reasonable at close to 6%, but the 3-year return is where you can see the impact, and it's really good at about 10% annualized. Within the infrastructure, international travel is still holding up. I would have expected it to start to normalize by now, but still holding up. So aeronautical revenues for the airport are still very healthy. I again would reiterate, I expect at some stage this international travel demand will moderate as the pent-up demand post-COVID normalizes. A lot of people have done international travel, which they couldn't do during the a couple of years of the pandemic. So yeah, at some stage, things will start to return to normal, and the healthy support to revenues for airports will become a bit more normal. The outlook for toll roads and bridges is pretty stable now, unless we go into another pandemic. Touch wood on that, but that doesn't happen. Nobody would like a repeat of 2020 or 2021. So yeah, with that, in absence of that, don't really think there is going to be much difference to the toll roads or bridges. Energy infrastructure is a bit interesting because it gets impacted by the price of oil, and the price of oil recently has pulled back a bit. However, it is one of the most volatile commodities in terms of its price. A lot of things can affect it. There's an inventory buildup in the US. Suddenly you see oil prices coming down, which is what's happening in recent days. There's a supply cut that is agreed upon by the OPEC, and you see a spike in oil price. Geopolitical conflict, if that spills over to the wider Middle Eastern region, suddenly could disrupt oil supply, and you could see oil price really shoot up. So there are a lot of factors which can affect it. But that aside, the broader picture is that there is a bit of an oversupply situation right now, given that Chinese economy is going through a slowdown. And they are the largest importer of oil. So when the largest importer of oil is slowing down, it does affect the overall demand for oil, and hence the price. There's downward pressure on the price of oil, and that affects the revenue generated by the energy infrastructure assets. So yeah, there is a bit of a subdued outlook for energy infrastructure. That's probably the weakest link within the infrastructure asset class. Utilities, as always, is pretty resilient in terms of their revenue, because they're oftentimes regulated with their margins, and irrespective of you having an economic downturn or even a pandemic, you are going to use power and water. So yeah, utility infrastructure will continue to see their revenue. It's pretty stable.
Right. So what is your view on listed property?
Another interesting one. Again, property valuations. Now, this is interesting in terms of property is a residential property. We aren't talking about residential property here, by the way. It's listed property, and most of that is commercial. But people would be able to relate the relationship between interest rates and property prices. Those who are keeping a tab on property, when interest rates go down, property prices go up. It is kind of similar even for listed property. When interest rates are expected to decline, that provides a valuation tailwind or valuation support for property assets. And you can see, like in the past returns that I've shown in that graph in the top left, the quarter has been really, really positive. I mean, New Zealand listed property was a relative underperformer, but even then they did over 6% for the quarter, which is significantly positive return for one quarter. Obviously, the Australian and global listed property had much stronger returns for the quarter. And that was on the back of expectation that interest rates might be coming down. Well, the market was in the process of pricing in more than 3 cuts, maybe 4 or 5 cuts for this year. So that remains to be seen whether that happens. But specifically talking about New Zealand, with my view that there is the possibility of an economic downturn in New Zealand. If that plays out, that's going to hamper revenues for commercial property because tenants will struggle to maintain rental payments. In an economic downturn, typically consumer spending slows down, discretionary spending is reduced, and thereby the income for businesses, which will be tenants for commercial properties, that'll go down. So there will be some bankruptcies, there will be some closures, and that would result in vacancies for commercial properties, and there'll be a sluggish renewal because there'll be some time lag until new businesses come in and start to fill in those vacancies. So based on that, I expect New Zealand listed property may underperform the Australian and global listed property. But by and large, I am positive on listed property, given that there is going to be some tailwind coming from lower interest rates. Now, within digging into it, subsectors of listed property, retail is at risk of slower consumer spending, particularly in New Zealand and to some extent in Australia as well. Globally, probably not so much, albeit there is still the overhang of restrictive monetary policy having an impact. So yeah, but it's more pronounced, that impact here in New Zealand and also in Australia to some extent. Office space is now changed from 3-4 years ago now. Pre-COVID was a different time period, it seems, for office space. The world got introduced to hybrid working model. It is going to stay. However, I have to mention that there is some retreat in the hybrid approach. A lot of businesses have been focusing on getting their staff, employees back to the office, and that could moderate things out a bit. But still, I think that overall demand for office space is going to be much less than what it was pre-COVID. For investment point of view, new modern office spaces are still very attractive. Businesses would prefer that, but at the expense of existing office space or a bit dated office space. So newer facilities, better facilities are still very much sought after by businesses. Industrial property is continuing to see demand. E-commerce is not abating. it probably shot up quite a bit as the world was locked away. But even now, when we can actually go out and visit the shops, the physical shops, e-commerce is still very much growing, and there is obviously the supply of there is the risk of supply disruptions. You might recall from post-COVID, there were bottlenecks which caused disruption and delays in supply, and now you've got the risk from geopolitical tensions. They might disrupt supply. So there is continued demand for warehouses and logistics assets. Lastly, would mention technology property assets, and to be more specific, I'm talking the likes of data centers. They continue to be in red hot demand. As one of the fund managers was telling me that data centers getting built are getting leased out or bought by big technology companies, even before they are fully completed and operational. So yeah, that I can't see that demand abating soon, particularly given that you've got artificial intelligence now driving a lot of advancement in technology, and you need data centers for that. So yeah.
Yeah, totally. And I think that's what makes international listed property quite exciting, because it's got a huge diversity across some different subsectors, including data center and long-term lease housing as well.
Absolutely. And that's why we are considering to move more allocation to global listed property away from New Zealand listed property.
That's wonderful to hear, Shahrukh. Investment committee in action. Okay, so international fixed interest and New Zealand fixed interest as well. It's I think from memory, 2022 we had the worst bond bear market in 80 years.
Something like that, but it was definitely the worst bond market for a generation. We haven't seen something like that, and even the more senior guys around also said that was not something that they could recall in recent history, or so it was a very, very tough period, very unique, and it was driven by the interest rates shooting up very, very aggressively in a very short period of time. And you can still see the impact of that in the top left graph, the 3-year return, which is gray bar pointing downwards. That is showing you that the 3-year return for international fixed interest is still negative. But the returns have turned, definitely. The 1-year return is positive, over 6%, and even for the quarter, it's really strong. And that is, again, we had such a quarter where the markets were pricing in interest rate cuts. So interest rates coming down helps income generating assets, and fixed income is income generating assets. So yeah, that really helped out the valuations over the last quarter of last year. I do believe that with interest rates coming down, that's my expectation over the medium term. There will be further valuation upside. However, as I said, the market may have priced in more rate cuts than what will eventuate. So there would be some fluctuation on that front. However, the medium-term outlook, like over the next year or two, I think there is further upside to that. But that aside, now with interest rates that high, there is increased opportunity to invest in high-quality fixed interest, which is also paying you a good yield. There was a long time where it just did not make sense to invest in fixed interest for getting a decent yield because the interest rates were so low. And the only benefit was that it was less volatile compared to the share market. So there was a diversification benefit. But now you can have the cake and eat it too kind of situation where you've got a really good yield to enjoy while it also remains less volatile than the share market. So the diversification benefits are there as well.
Sounds like you're bullish.
very bullish on international fixed interest. Well, fixed interest in general. Yeah, so that's the same story for New Zealand fixed interest as well. Again, the longer term return is negative, which is pointing to the era which was very, very tough for bonds, very unusually tough. But there has been some strong recovery since, and particularly over the last quarter. Now, for New Zealand, I'm also, again, going to reiterate that my view is that the interest rates have peaked. There is the odd economist out there saying that, we might see the OCR go further up. I do not agree with that. I think the next move is going to be down. When that's going to happen is probably more debatable. Remains to be seen. Inflation has been more persistent in New Zealand, but still is coming down, which is the longer term trend, and I expect that it will continue to come down. And as I've pointed out already, the RBNZ is now solely focused on bringing inflation down, so they may tolerate breaking down the economy if that is the cost of bringing inflation down. It's again, I don't think it's going to be, even if there is a recession in New Zealand, it's not going to be a prolonged recession because the monetary policy is at a level where there is that room for RBNZ to pull down interest rates and help out the economy. However, I think they are very much focused on bringing inflation down right now. And they've also pointed out this comment that they believe that employment level is unsustainably high, i.e. unemployment is unsustainably low. And it doesn't seem to be, moving up, which also points out to the fact that why cut interest rates unless not necessary? So yeah, that outlook is a little bit uncertain on the economic front for New Zealand. However, there is, the opportunity for investing in high income paying bonds now that the interest rates have been high for a good 18 months, better part of 2 years. So there is increased opportunity to invest in good quality fixed interest, which is also paying you a good yield, and it is lower volatility than equities.
Thank you, Shahrukh, for sharing your view on New Zealand fixed interest. Now I've got a question for you. Let's say if we've got an investor sitting in front of you, and the person is either sitting on the sideline with a bit of cash, unsure how to invest, or they may have a portfolio they're just thinking about reviewing it. What would be the top 3 tips you would give to this person about investing in 2024?
Okay, so slightly different for both scenarios. If you've got if you've got a portfolio, you're already invested, depending on what you've been investing in, you may want to rejig some of your positioning based on what I have suggested. But hey, I don't know your personal circumstances, so get in touch and can definitely take a look and help you out. With respect to sitting on the sidelines, well, yeah, it would have been great if you were invested last year. But a lot of people obviously preferred the term deposits, which were increasing and still are pretty, high. Some of the banks are offering 6%, which is a very attractive return given if you've seen the performance over the last probably 2 years. We have recovered a fair bit of ground, but we are still not, comparing to the term deposit returns for probably the better part of the last 3 years, given the negative 2022. So you might consider continuing to sit on the sidelines, but hey, I can tell you that term deposits do not beat the share markets over longer term. There might be such periods where the window, if you are looking at a certain window like a 2-year, 3-year return, you might end up arguing that hey, the term deposits or the cash has outperformed. But if you are a long-term investor, you're definitely going to do better than sitting on the sidelines. So invest in a diversified portfolio, seek financial advice, and then enjoy the ride is probably the third one, which is very important because staying put is sometimes the best strategy. Once you're invested, assuming that you're not invested in crappy investments. So that's why you need to seek financial advice, and you need to be diversified, not really a handful of New Zealand companies, even though, New Zealand companies are not really that bad, but hey, still diversification is the key. But enjoying the ride and holding steady is really, really important. Time in the market is your biggest friend. I've got a graph a couple of slides later which highlights that, so maybe we can go there and then jump back if needed. Joyce, there we are. Oh no, yep, there it is. So that's showing the S&P 500 going back 80 years from 1942 till September 2023. So what you can see is the blue mountains and the yellow valleys. The yellow valleys are whenever the market has had a negative return, more than 20%. So it's a bear market. And the blue mountains are when there's been a bull market, which is positive 20% or more. What you can notice is, firstly, the mountains are much longer and much bigger than the valleys. So the market goes up much more than it goes down, even though it may feel like, the market is not really providing you a return when you're going through a bear market, or you've just had a bear market, which is, we've had a bear market in 2022. So there is still some investor fatigue. But eventually the bear market passes on and gives way for the next bull market, which is the mountain, and the mountain then continues on for a few years. Typically, these bear markets happen every 5 years, give or take. Sometimes, they've been about 10, 12 years apart. Sometimes they've happened, a couple of years apart. So it really depends on what's the trigger. But generally, a good rule of thumb is like every 5 years or 8 years is when you get a negative year. So we've just had a negative year, which was 2022. And that is what you can see, the rightmost valley at the rightmost end of this graph. That was 2022. And then you can see a small mountain beginning, which is what we had 2023. Now, this graph is until end of September. So if this was updated until now, that small mountain will be much bigger, because we had a stellar quarter last year, and this year has been positive so far as well. I will have the updated graph in the next few weeks, and we'll share that in my monthly video update. So look out for that. But the key takeaway is, if you stay invested over time, you will be much better off than trying to time the market or panicking. And that's where financial advice can really help you out, because financial advisors do this for a living and are a lot more attuned to what's happening in the financial market, rather than just looking at your portfolio performance.
Great answer. Thanks, Shahrukh. Do you have any closing remarks before we wrap this up?
Yeah, just one. I would like to mention, just go back a bit, before that graph, that one. So we still have this alternative to cash and bank. So a lot of people will be holding term deposits, and the term deposits, I can't argue, are paying a really good return. However, they do come with the requirement of being fixed term. So you can't touch the money for the term, or you forfeit their interest. So there is the option of, parking some cash while not really fully giving up on the higher return. So we've got the call account, which is earning the OCR, which is 5.5% gross. And because it's a call account, it can be accessed within 24 hours. There is no term or locking period. So there is something to think about. If you've got money sitting in a call account, which is like an emergency fund and not really earning that much, here's an option to consider.
Brilliant.
Lastly, if you just move on, that one, the slide before, which is showing our performance until December. So this is the Saturn performance, going from conservative to the top, at the top, to the very aggressive at the bottom, depending on what suits your circumstances. Again, not personalized advice. Reach out to us, and we will help you determine what is the best approach going forward. But what I want to highlight here is we've had a strong 1 year. You can see the 1 year performance from balanced onwards. We've got double-digit returns. The quarter was really strong, but 2022 is still impacting the 3-year return, and to some extent even the 5-year return. The 5-year return is also at this point in time not what I would expect from the respective strategies. For example, balanced at 4.67% for 5 years annualized is a bit on the lower end. I would imagine that to be closer to mid 5s or 6, and so on. So these returns do fluctuate from time to time depending on when you've had a negative year. And right at the bottom, you can see the term deposit rates, the return on term deposit, and the only period where it is beating the strategies is actually the 3-year. So hence what I've just mentioned, that you will get these windows where the term deposit return seems to be attractive and a no-brainer, but actually over time it is not. Our strategies and investment in financial markets through good advice is always going to outperform. So yeah, that's probably it from my side.
Fantastic. So I'll just bring up your contact details. So yeah, it's great insight as always. A lot for us and the investors to think about. Last but not the least, I just want to thank everybody's time and support. Thank you, Shahrukh, for being here and giving a fantastic presentation backed with lots of facts and data. For the audience, if you are interested in this kind of content, you can subscribe to our monthly newsletter. How you do that is I will post a link under the YouTube video. Additionally, you can go on to our website, saturnadvice.co.nz, and subscribe from there. So thank you for your time. We will see you at the next webinar. Bye.